Hi and welcome back to Cheeky Crypto. My name is Nick and today guys we're going to be jumping down into the world of Bitcoin, taking a look at the most recent price action for BTC, what I think is likely to happen next and all that wonderful stuff. Now as I get into today's video, if you do find it useful and informative, smash that like button. I really do appreciate that. If you're watching on YouTube and you're not yet subscribed, what are you waiting for? Check it out. Subscribe, tap the bell, select all the notifications, and in doing so you will not miss another video update. If you're watching this on X, then why not give us a follow and a retweet. Really do appreciate all of that. Helps push the content out to more like-minded individuals. Okay guys, let's waste no more time. Let's jump right down into the desktop and take a look at what's going on with Bitcoin. We'll kick things off with the 1 hour time frame. So here we have Bitcoin paired up with USDT, the BitGet spot exchange, and the 1 hour time frame. As you can kind of see, we were talking yesterday about a move to the upside. We actually were able to target this out about an hour or so just before we actually got rejected. Okay, so we were talking about a potential theoretical move up to the 200 EMA. This is essentially going to be 26,500, 26,600, and then get rejected. But we started to see that there's a three-wave structure here, and our target range became a little bit lower, 26,312 to 26,392. We actually narrowly missed this. I'll zoom in so you can see how close that wick was right here. It basically wicked up to a high of 26,306. Okay, so we got close to our target, but we did not get back in on a short position. So for those who are familiar with yesterday's video, I had exited my short down here and I was looking to re-enter into the short a little bit higher. I think that opportunity has come back around again, but it is the weekend, so we do have to be a little bit cautious. We'll talk about trades later in the video though. So for now, we can see that we kind of moved up. We just narrowly missed the expectations, and then we got moved, we kind of got rejected from here and started to move on down. Now, taking a look at our structure here, I suspect that we have another leg down before we rally. Again, just taking a look at the pattern and data, I would suspect that the behavior of people here, we are likely to get rejected on this 50 EMA, and there's a potential theoretical short taking us down a little bit deeper towards our 25,484 to 25,604. Okay, it's just worth noting though that our minimum expectations have already been met with this local low over here that came down lower than this one and this one. Okay, so the local move at the moment, the one that came down yesterday at 3 o'clock UTC +1, essentially is enough of a move to the downside to say our minimum expectations have been met. However, I expect a little bit further under a three-wave pattern that would look like this: A, B, and then C. And all of that, of course, will tally in nicely with a move from the higher side here, with our move up to this end. Moving down, you can see that we have a little bit deeper, which means, you know, we might still overextend a little bit deeper, but also our minimum expectations would be met. This is 25,169 to 25,382. I'll show you what that looks like. It's an A, B, and C structure like this. But internally, we have that three-wave pattern there that basically could mean that we are done. Of course, we could bounce from this one and then move down in another three-wave drop to kind of get into that C wave, making the entire thing a large A, B, and C structure like so. So there's a few things to kind of consider in there. It can be complex, but for the most part, I'm still bearish here on BTC. That hasn't really changed. I'm going to remove all of those out of there so we can see that there's a couple of target ranges. The immediate target being this one just down here. Okay, so for the most part, that's kind of what I'm looking at. I'm thinking that's the obvious areas at the moment for retracement. We'll target out the 25,485 to 25,603, potentially coming straight down to 25,172 to 25,382. However, I suspect that's probably not going to happen right away. So at the moment, yeah, that's kind of the obvious thing to kind of be thinking about. I do suspect we're likely to move on down there just a little bit now. The only thing that's got a little bit of concern is the 4 hour time frame. Okay, it is oversold and actually just coming up from oversold. So we might be able to break above. If we were able to break above the swing high that we have just here, we'll mark it up at 26,306, then that would actually mean that this low expectation completed our structure. Okay, so our minimum expectation, this one down here, at the 3 o'clock UTC +1 yesterday afternoon. If we rally up higher than 26,306, then essentially that means, yeah, we're done. these ones are no longer valid. We can just kind of forget those, and we'll actually probably be moving more up towards that 200 EMA, where we'll actually look at this thing maybe as an irregular flat or some other kind of structure at all. But we'll obviously have an idea on that as things would unfold. Ultimately, this short here is out of it at the moment, so I'm going to remove that. But if anyone who is in still think I am on target for the lows, that hasn't changed. So I'm still thinking 23,287 to 24,113. I'm going to remove this short here for now, but you can still see we're on track for everything that is going on to the downside. So let's go ahead and bring this up into our daily time frame. The daily time frame here is still on the BetGet spot exchange with the Bitcoin USDT pair. We are still looking to track down into that third wave. So the fifth wave on our hourly chart essentially is basically completing a three-wave structure here, or a third wave structure on the daily time frame. Once complete, we rally up into a fourth wave and then down into the fifth. Again, this is something that's going to have take several weeks to kind of play out, but the target range is 22,659 to 23,426. So nothing has really changed on a daily time frame. Everything still is remaining as it was prior. We are bearish. We are below the 50 EMA, the 200 EMA, and like I said yesterday, I suspect that 50 EMA is going to be dropping below that 200 EMA considering recent price action. Ultimately, I would say, yeah, we're right on track to continue this move to the downside. Again, we'll see how things kind of play out as more time progresses. Over the weekend, it will be incredibly interesting. Usually the volatility drops down a little bit, so it's not as volatile. Can be kind of just more of like a ranging market, things like that. But on the daily time frame, not much else to really note at this point. It's not much has changed really on the daily time frame over the last couple of days or so. So let's go ahead and take a look at the weekly. And in here, we're going to take a look at retracements, specifically on the bull market, bear market retracement levels. There's some interesting things. Now, this one here is the Bitcoin USD 1 week Bitstamp data, but I might put it into stable coins and use this one maybe. I don't know. We'll try it here for now. The USD pair can be useful, but I find that the USDT pair is a little bit better. But we've got more data on the USD side of things, so we'll stick it here to start with. So let's start things off by taking a look at a few things here on the weekly chart, right? So we obviously had the 2013 high and we had the retracements, right? And what we're really going to be taking a look at, let me get rid of that, is the retracement levels from a Fibonacci point of view, okay? So if we had this entire peak here, all the way down to the bottom of here, then we had our bear market retrace just past the 702 and just above the 618. It's actually closer to the 702. Okay, so you can see it right in there. That's the entire structured move. Okay, now obviously on that retracement, we can also acknowledge that there was a bounce here as well. So we have the 1, 2, and then 3. Okay, and if I measure that first wave right here, and we pull that down over to here, we can see that we went down and bounced from the 1.236. So everything there is like aligned to the three-wave structure, right? A three-wave pattern basically lands between 1 and 1.236. Okay, and retracement of the total structure being above the 618 is actually also very positive. And the 702 is also a key area. Now we have the 2017 run, right? And we can see if we take the peak to the low, we retrace down to the 618. Okay, and we rested right there on the 618. If I pull this across, just so you can kind of see price action coming right down onto that 618. Okay, and then of course we had the 702 being the support area when we had the March 2020 retracement. Again, we have a three-wave drop in that bear market of 2018 right in here, and we can acknowledge the three-wave pattern that sits inside there with the ABC, and the retracement of this essentially brings us right down between 1 and 1.236. Okay, so nothing terribly too unusual there about this one. Basically just coming right down to kind of what you would expect it to do. Okay, then we get into the 2021 or 2020, 2021 kind of bull market. We have the entire pattern, entire structure right in here. We see that we came down and we retraced in this bear market at this point in time past the 618, past the 702, and close to the 50% retracement level. Again, a 50% retracement level is not terribly too uncommon. Again, we have the bear market in itself, right? We have a interesting structured move to the downside, not a three-wave pattern, and this is for the obvious reasons. It's actually a W, X, Y, X, and Z. And in here, we pick that first retracement, or that first wave, that W wave. Pull it over to the X, you can see that we came down deeper than the 1.382. So as I said earlier, right, over in the previous bear market lows, we had three-wave patterns, right? We had the three-wave drop here, and we had a three-wave drop over here, right? And those retracements in there stayed between 1 and 1.236, and they didn't extend anywhere near those same kind of levels. In fact, you can see this one here right on that 1.618. And if we take this one here, and again, this works a little bit better on the USDT pairing than it does on the USD pairing, but you can see right here, actually just a little bit above the 1-to-1, right? It didn't go down deeper. Okay, and these are very critical things. And inside this particular point here, you can see that as soon as we drop down lower than the 1.38, well, technically, as soon as we drop down lower than 1.236, we realized that we had to come down into the Z wave. We had to finish this one off, right? So we bounced up, we came back down into the November lows. And of course, people are saying, oh, well, that's great in hindsight. No, we're calling this during this entire time. I was saying that we really were expecting a new bear market low. All the way from June 2022 all the way through to August 2022, and of course, we didn't know what was going to be the catalyst for that, but we eventually got there with FTX. And so, from a retracement point of view and the Fibonacci sequencing levels, we can see some interesting things, right? We've definitely come down much more deeply than we had done previously in these bear market lows, right? Even though the percentage drops were more significant in here, as in this, and this drop was an 86% drop, and this drop over this side was a 84% drop. If we take a look at our retracement from our peak up at 69K down to our current low, it's 77%. Okay, so although we've come down deeper, or not as deep from a percentage point of view, we came down deeper from a Fibonacci retracement point of view. And this is actually quite a damaging thing, because the Fibonacci sequencing is what's kind of resonating with people subconsciously, right? People are reacting to these levels, these key levels, whether that's the 618, the 702, the 786, and so forth. And in what we've got here in this particular case is actually we've come down aggressively so far from a Fibonacci point of view. Okay, we pull this back all the way down here, for example, you can see that we're just hovering on that kind of 50%. At the moment, we rallied back up again, getting the 702 rejection and looking at the 786 as the next kind of area of resistance. So from our weekly standpoint, we obviously sit in a position where things are not looking necessarily as good as they need to. And so therefore we potentially look for further downside. And well, where does our trend line sit? About 81%. That gets you to about 12.5K. Coming down, if we were looking for like an 84% drop to marry up with the previous bear market, then we're talking 10K Bitcoin. And of course, there's the big bearish situations, which we've been talking about for a while on the channel, which is essentially maybe there's a big three-wave pattern that takes us down even deeper than this, and maybe we'd lose $10,000 altogether and drop down even significantly lower. But those are thoughts and things for another day. For now, I just wanted to kind of go through some of these things. There was questions in our AMA yesterday about Fibonacci retracement levels and what resonates best with Bitcoin. It's not so much what resonates with Bitcoin, it's what resonates with people. The 702 retracement is a very nice one. It's not a standard Fibonacci level though, but it is something that you can find that Bitcoin's price reacts to quite a bit. 618 is an obvious one. A lot of people get rejected or find support on the 618. Same with the 786 as well. But there's a lot of different levels to the Fibonacci sequencing. Lots of Elliott wave theory specific levels, as well as the standard ones that everyone will be familiar with, such as the 618s. So yeah, let's go ahead and move this back up into the world of data then. So on our membership website, membership.𝗕𝗘𝗪𝗀𝗀𝗧𝗏, linked in the description below. This is our membership website where we basically have so much to offer the community. Everything from AMAs twice weekly, exclusive videos, exclusive technical analysis, course material, on-chain data, articles, reviews, so much, right? We do offer a 7-day free trial across all the plans, and it's completely kind of risk-free. Essentially, if you don't want to continue, just go to your profile area and go ahead and basically cancel it, and it's as simple as that. If you do not cancel it from your profile, you will be charged and all that kind of stuff, so just bear that in mind. But today's video, we're going to be jumping into the data zone and the on-chain data for Bitcoin, okay? And we're going to come on over into that, and it's going to look like this. Now, I'm actually in the middle of adding more to the on-chain data, and that's going to be out in a couple of weeks' time, so I'm super excited to kind of revamp all of this, which is going to be pretty cool. I think we're going to have access to so much more interesting data points that are going to help us make more informed decisions around the cryptocurrencies that we're most interested in. We will not just be limited to Bitcoin, Cardano, Ethereum, which is the one I never really look at, and XRP. I'm expanding this into so much more, so it's going to be really cool. But anyway, let's get into the world of Bitcoin here. So our overview basically just shows us the all-time high, the number of days since this all-time high, the circulating supply, all the kind of usual things, a top level that you would expect to kind of see. Anything of note? Well, we've got 19,476,850 BTC in circulating supply. It's a pretty meaty number. You've got to bear in mind there's only 21 million ever that can be mined, right? And so we've only really got a small amount more Bitcoin to issue, which means it's more important not to focus in on the new Bitcoin that is being mined at this point, but more focus on the existing Bitcoin that is out there. What's going to create that Bitcoin to get shrinkage in that Bitcoin supply or an increase in that Bitcoin demand, right? Those are the two things that are really important here. And your Bitcoin halving event is just absolute nonsense and noise in the space. It doesn't mean that much. And this is controversial because people really kind of like the whole Bitcoin halving thing, but we need to be real about it, right? There's 19,467,000 Bitcoin out there. Whether you halve the new mined Bitcoin and the rewards for mining Bitcoin, it really isn't going to have a huge dent. It's not going to get rid of 19.4 million BTC. It's only going to prevent that number from getting larger, and it's already kind of getting close to its max, right? So we can't really be thinking the issuance of Bitcoin is going to have a huge impact to the supply. The supply demand metrics are already imbalanced to a degree, and halving the new supply is not going to make a big shock to that supply. Okay, it's not going to be a big shock wave that's going to create a huge imbalance, right? It just simply isn't. It was more meaningful a few years back where the supply was smaller. Now the supply is where it is. It's not as impactful. So just don't get caught out by the whole Bitcoin halving thing. Otherwise, you might end up in a situation where you are with Litecoin. A lot of people thinking that Litecoin's halving event was going to be a massive catalyst. Lots of speculation beforehand, of course, but it hasn't exactly ended well. And there's many different factors, of course, into that, but you can kind of see the idea of what I'm talking about here. The logic behind this is quite simple. There's 19.4 million. Whether you want to kind of halve the rewards, it really has little impact on the supply metrics. But there are some really good positives, right? We do see a lot of spot ETF stuff going on in the background. That is going to potentially create huge demand, which in itself can create an imbalance in the supply demand metrics, which is going to drive price higher. So there's lots of really good things. Just don't look at the Bitcoin halving as the gospel for the next bull market, because it's not. There's speculation on that could drive it, but it's not going to be the actual catalyst for it. And we got to bear in mind the coincidence, or that is more than likely going to unfold, which is the Bitcoin spot ETFs will more than likely go live when the Bitcoin halving happens. And what it'll do is it will trick everyone into thinking the Bitcoin halving was the catalyst of that next bull market. It wasn't the halving, it was the spot ETFs. That's how I think things are going to happen. I think we're going to see that coincidence of both those things happening at the same time, and then we'll see the bull market. But, speculation nonetheless. Taking a look at wallet counts, we can obviously jump into the world of wallet counts and find out how many wallets there are with specific numbers of Bitcoin. There's 10 different wallets here. Retail wallets, which is basically wallets that have over 0.001 all the way through to wallets that have over 10 Bitcoin. And then we've got the institutional level wallets, which are basically over 100 Bitcoin or over 1 million Bitcoin, right? No one has over 1 million Bitcoin, by the way. So we've got to take 5 wallets on the retail side, 5 wallets on the institutional side. And for the most part, we can see that not terribly too much has really occurred over the last little while. It's been rather flat. So 100,000 Bitcoin or more, there's 4 wallets. 10,000 Bitcoin or more, there's 108 wallets. 1,000 Bitcoin or more, there's 2,018 wallets. 100 Bitcoin, there's 15,833 wallets. And then, of course, on the retail side, we have the 10 Bitcoin or more, 156,000 of those, 1 million wallets that have over 1 Bitcoin, 4.4 million that have over 0.1 Bitcoin, 12.2 million that have over 0.01 million, and then Bitcoin Dust at 0.001, there's 23.4 million. Okay, now there's a few things here that's worth noting, right? Because a lot of people will kind of just have a look at the overview, for example, and say, look, there's 48.6 million Bitcoin holders out there. And I would then stress to the fact that no, there isn't. There's 23,400 that actually have 0.001 Bitcoin or more in them. And then we have to argue, actually, is that even meaningful? 0.01 Bitcoin, there's 12 million. So actually, are there only really 12 million Bitcoin holders at this point? What about, does it have to be more than that? 0.1 Bitcoin, if you're like serious about it, there's actually only 4.4 million. And if you're a 1 Bitcoiner, well, there's 1 million wallets, right? But what we do want to know here is that for the most part, there's a lot of Bitcoin held at the retail level. A lot of that circulating supply is held at that retail level, and that concerns me. Not that it's a massive amount or disproportion to kind of the institutional level, just that it's actually a sizable amount that could potentially create shockwaves within the price action, because if retail investors are emotional, specifically when they overreact or react to price movements, then we might see a big move to the downside. Now, we take this wallet here, for example, where we have 1 million wallets that have over 1 Bitcoin. Well, that's cool and everything. However, considering these guys have been accumulating aggressively during the bear market, and we might see another downturn, we might finally see that shakeout that we had seen in previous years. Now, if we do, I suspect a 20 to 30% drop in these wallets. That would be 200 to 300,000 Bitcoin just going out there into circulating supply. That would be a pretty big shock to the ecosystem and would drag down the price action. So holding 1 million Bitcoin at this retail level, I find quite concerning, because we're not in control as a mass of retail investors to say, hold, don't sell, don't do this, don't do that. And in fact, there might be a lot of reasons why those retail investors have to sell. There's lots of different things going on in lots of different places around the world that could potentially cause some pain for certain retail investors that actually they need to sell their 1 Bitcoin. And as such, we might see in the entire space, a bit of a move to the downside. Now, don't get me wrong, I wouldn't expect it to all happen instantaneously. It could be a cascading effect where maybe some of the high net worth individuals that have 10 Bitcoin or more, who have also aggressively been buying, maybe all of a sudden a few of those start to sell off a little bit, okay, start to kind of cash in some of their Bitcoin. And if that is the case, then that might cause some of the 1 Bitcoiners to start to panic. And if some of those 1 Bitcoiners panic, then maybe others will start to follow. And you end up with this cascading effect. Now, it can go from bottom up and it can go from top down. And no one really has the answer to that. But I do suspect with so much Bitcoin sat at that retail layer, I am a little bit concerned. Now, the institutional layer also comes with its own concerns as well. When they accumulate a vast amount, they can control the market in a very similar way. But it would be more calculated. It wouldn't be an overreaction to price movement, for example. And that wallet would be the 10,000 BTC or more. They've aggressively accumulated during the bear market like they did back in 2018. However, in 2018, they actually completely crashed the market into the bear market low by flooding the market with excess Bitcoin. You can see that here depicted, right? They accumulate during the bear market and then bam, they flooded it in Bitcoin to get in that bear market low point. And you can see something very similar. They've aggressively purchased here during the bear market and they've started their downturn. It's not as aggressive as it was previously. And the question becomes, are they even going to do something similar? What was the catalyst for this move to the downside? Only really a handful of people know. Ultimately, we look at the data, we say it's got a very similar setup. It could happen. Not to say that it will, but we are looking here at already aggressive sell-offs when it comes to these wallets as well. Okay, so we've got to be cautious because these guys also control the market. And so there's concern at the institutional layer in the same way that we have concerns at the retail layer. Although this looks positive, they've been buying, historic patterns are giving me the kind of concerns. From the whale side of things, they're not buying yet. So so I suspect that essentially that means that they suspect that retail probably will sell. There's always a buyer, there's always a seller. And if whales are not selling, are not buying, and they've only been selling, then at some point they are going to be looking for buying up Bitcoin. And we'll have to find out what price that's going to be. So I have concerns, and obviously this data will eventually turn into a more positive data set. But for now, I'm just not that positive on it, which actually brings me over into some of the other things that are going on in the world around news, because that's great. I didn't prepare that very well, did I? There we go. BRICS member India ditches the US dollar and purchases 1 billion barrels of oil with rupees for the first time ever. So we already know that the US dollar on the world stage and its global reserve currency is being tested by BRICS heavily, and it makes sense to do so, in my opinion. Just logically, it makes sense. And so it's going to be one of those. Keep a close eye on this, because again, the dollar is not in a strong position, because we also saw that the US debt jumped by $97 billion in just 1 week. And basically, this is going to fuel an era of financial repression. So the US reserve currency is out of control. Okay, the debt at the beginning is basically 32.759 trillion at the point that this article was published. And so it's grown between the 16th of August and the 22nd of August by 97.7 billion. And so we already know that the US dollar is being ditched by the BRICS members. They're purchasing outside of the US dollar reserve as a reserve currency. And we already see that debt is just staggeringly increasing at the US level. This is a catalyst for a massive problem in the future for the US, for crypto, for the stock market. It's not going to be a good sign. So prepare for pain, I think, essentially is what I'm going to be saying, because I think there's data from a charting point of view that are not looking great. We have on-chain metrics that are basically suggesting to us that, retail are the ones that are holding up Bitcoin at the moment, and if they start to crumble, then Bitcoin's going to be coming down hard. And then we have things like this, BRICS going on in the real world. We've got the US debt. We have a housing crisis, even though some professionals in the space are saying that actually it's okay. We also think it's being propped up in some places. I'm not sure how long it's going to be able to survive. In my opinion, the interest rates the way that they are, with the mortgage rates the way they are. I mean, I can't speak for every country, but here in the UK, you can only lock in your rate for a few years. It might be 2 years, 3 years, 5 years. Some cases maybe a little bit more than that. But for the most part, there's rates that are coming up for renewal, and the renewal rates are astonishingly high, and that's going to cause major problems within the housing markets, and specifically at the retail layer, because they are going to be the ones that are going to struggle the most, right? They have to pay their mortgage payments. If they are not earning as much, how are they going to do this? The cost of living, the cost of energy, the cost of fuels in general, it's kind of going to be compounding together to kind of either see a lot of retail investors downsizing their homes, or altogether just unfortunately defaulting on them. And although there is legislation in the UK side that they can't be repossessed for 12 months, it is going to basically create a bit of a cascading problem further down the line. And so we've got a few things to kind of consider with all of that kind of stuff, which I guess brings me on to taking a look at the exchange-based news for today. So liquidations in the last 24 hours sit at $15.8 million. OKX was the exchange with the most amount of liquidations at 4.15 million. 63.81% of positions were long that got wiped out, and 36.19 were short positions that were liquidated. OKX represents 23.13% of liquidations, Binance 25.31, Deribit 16.22, and that is a new entry and is unusual. Okay, so Here's the thing. Why would there be $2.5 million of liquidations on that particular exchange? 100% of the positions were long positions. So it can be true. It can just be maybe a couple of really large players essentially just got wiped out. Or alternatively, they need to essentially liquidate people because they're not insolvent, or they're potentially not solvent and potentially are looking at some worrying times. These are the things that we were talking about aggressively with FTX when we saw their liquidations spike up in an unusual way. So very bit one to look at, dig into, find out what's going on, do your own research, all that kind of stuff. One of the things though that I would say, I say it all the time, I don't keep my cryptocurrency on exchanges. I keep it in my ledger, my hardware wallet. And again, don't believe that FUD about private keys and all that nonsense. Know what it is that you hold. It's a hardware wallet. You have to plug it into a computer. You have to sign those transactions to confirm your actions. It is hardware. Understand the difference between hardware, firmware, and software, and you should be into a winner. But I don't keep my cryptocurrency on exchanges. I keep it in my ledger device. This means that I'm less concerned about which exchanges are surviving. I am more concerned about, do I have an account with all these different exchanges, and do I have flexibility in my trading options? Which essentially brings me to the next part. BitGet is my go-to platform. I use this for 100% of my leverage trades and 90 to 95% of my spot trades. Okay, now obviously I do not keep my cryptocurrency on the exchanges, as I just said. There are some exceptions to this. One, the exception would be that if you're on leverage trading, you're going to have to keep your stable coins or whatever it is that you're leveraging on the platform. That is an unnegotiable. You can't get around that, and it is something that you're going to have to kind of cope with. So my trading positions they're okay. They're meaningful to me. They're not massive enough that if something were to go wrong with an exchange and I were to lose that amount of money, that's okay. It's not the end of the world, right? My trading positions are my trading positions. From a leverage point of view, it's not a massive amount of my portfolio. And when I do make winning trades, you withdraw the winning part, you leave in whatever your trading bag is made up of. So whether that's $1,000, $10,000, whatever that may be, right? And you basically keep that and you withdraw any winning trades that you have, right? And get that back onto your ledger device. So from leverage side is one thing. Well, spot trading is something else that sometimes you might want to do market orders. Sometimes you might want to do limit orders. If you're going to be doing a limit order, you need to keep stables on the platform. And if you do that, then that's where you want to spread the risk across multiple different platforms from a spot point of view. Now, as I said, BitGet is my go-to platform, and I do 90 to 95% of my spot buys there, right? But that's because I'm not using limit. I am pretty much just doing spot. Because I have the ability to sit at this desk and watch the chart as much as I do, I can take advantage of spot buying via market. Okay, that's a great way of going if you have access to a computer 24/7, 365 and all that kind of stuff. That's not going to fit many investors though. Most and the majority will be doing a 9-to-5 job as well. So what you tend to find is you have to keep stable coins on the platform. And so the idea there is that you do this across multiple, maybe you have 10% on each exchange, for example. You have 10 different exchanges. Ultimately, that's kind of the way to spread the risk. You're not going to be centralized in one point. Obviously, it's more to manage and all that kind of stuff, but it's the most secure way in my humble opinion. Now, if you haven't yet got an account with BitGet, as I said, it's my go-to platform. There's an affiliate link in the description down below. If you do use that link, you are eligible for up to $8,000 of rewards, depending on how much you deposit and trade on the platform. Ultimately, I would say sign up to all of these accounts, whether that is a BitGet, Coinbase, Binance, KuCoin, Gate.io, Crypto.com, Bybit, Mexi, you name it. Go ahead and sign up to it. I have. I've got accounts with all of them, and for good reason, because it gives you flexibility. Okay, so sign up to them all. Get familiar with how they work. How do you onboard? How do you withdraw both fiat and crypto? Do you need to do KYC? Do you need to link bank accounts? Do all these things. Get yourself set up and set yourself up for success in the future. Don't give yourself unnecessary risk as well. So that brings me on to the next section, which is trades. We've seen some good trades going on in the Discord. We were able to take advantage of shorting Bitcoin, shorting Matic, and a few others. So it's good to kind of see these things going on in here. We can also jump back down into the charts and talk about potential opportunities in there as well. Let me see if I can find this one. Yeah, this one. So my expectations are that we will move back to the upside. Now, we can short where we are right now. It's not a bad position. If I were to do this, I would want it to be reasonably tight. So let's just take market order here. We put our stop loss above a swing high, and we'll put our take profit down on this low entry. It gives us a 1.83. It's not bad. It's not a bad trade opportunity. As long as it's above 1.5, I'm okay with risk reward ratio being there. Good to have that stop loss above the recent swing high. So you could still move up a little ways, but ultimately our structure would break if we were to go up higher, and then we'll target out that low range down there. Once that is done, we could potentially go long. I wouldn't really want to because we're in a bearish move here, so going long would be bad, but I do suspect another move up there if we wanted to, so that's an option, but that would be something for potentially another day. I think though, guys, that's going to wrap up today's video. So if you have found this useful and informative, smash that like button. I do appreciate that. If you are new to the channel, then why not go ahead and subscribe, tap the bell, select all the notifications, and in doing so you will be kept up to date with everything that we do here at Cheeky Crypto. If you haven't yet jumped into our Discord, why not check it out, linked in the description below. Until the next one though, guys, have a fantastic day.